Hello everyone, welcome to SST College of Arts and Commerce. This is SST Edupedia. I am Deepika Valecha, Assistant Professor in Department of Commerce, Banking and Insurance. Today we will be learning about a course called as Fundamental Accounting or Financial Accounting in Semester 1. Now the topic which today we are going to learn is related to accounting standards. Accounting standard, what do you mean by it? Accounting standards are the authoritative standards for the financial reporting and are the primary source of generally accepted accounting principles, that is GAAP. Accounting standards specifies how the transactions and the other events are recognized, measured and presented, disclosed in the financial statements. Now basically these standards, accounting standards are the generally accepted principles, or you can say the methodology by which the various accounting practices and practices are undertaken by the various firms and even institutes, also companies. So an accounting standard is a set of practices and the policies used to systemize the bookkeeping and other accounting functions across the firms over the period of time. Accounting standards applies to the full breadth of an entity's financial picture, includes assets, liabilities, revenues, expenses and the shareholders' equity. So in this accounting standards methodology, the detailing of all the assets of an entity such as fixed assets, investments and other assets like current assets which have the duration of less than 1 year is also given, like how these accounts to be maintained. Say for example, if you talk about depreciation, depreciation is a non-cash expenses which is related to the fixed assets. So what kind of a methodology to be adopted for depreciation accounting, that is mentioned in accounting standards for depreciation accounting. So here are various accounting standards for each and every item is given, so that it will be easy for any organization or a firm to make a detailing or detailed report or detailing of any transaction. Banks, investors and the regulatory agencies count on accounting standards to ensure the information about the given entity is relevant and accurate. So all the major entities in the financial reporting like banks, financial institutions, investors, regulatory authorities like SEBI, NSE, all these rely on if the accounts are prepared on the basis of the accounting standards. So it gives the relevance for each and every transactions. Now, International Financial Reporting Standards. Now, what is actually IFRS? IFRS stands for International Financial Reporting Standards. These indicates the with the title only we can say that these are the standards, or you can say norms, which are aimed to be practiced at the global level. That means all over in world, internationally, these financial reporting standards are practiced to maintain the uniformity in terms of accounting for each and every organization across the globe, that is across the world. The goal is to achieve a single set of high quality common accounting standards used worldwide, and these standards are the result of convergence of international viewpoints. Also, these standards are for the publicly accountable entities. So here we can say to maintain the consistency and also the uniformity in accounting, all over world there are the international financial reporting standards which are practiced, and on the basis of IFRS only, these accounting standards are followed by various entities, which ensures that there should be a uniformity. Now, why there is a need for accounting standards? First of all, for bringing the uniformity in accounting, for improving the reliability of these financial statements. See, if there is a uniformity, then we can make a comparison between the firms in two different firms also, to maintain the reliability also, and to make the proper comparison base also. It simplifies the accounting information, and also it prevents the frauds and manipulations. It helps the auditors to make and do the audit, conduct the audit on the basic norms and the policies which are framed as per the detailing as per the norms given by the IFRS, so that the errors and frauds can be minimized and detected. Now, importance of accounting standards. Again, it brings the uniformity in the accounting systems. Like, for example, if we have accounting standard 6, which governs the whole depreciation accounting. So, here in depreciation accounting in all over world, we can say in various entities, the same principles will be followed, so that we can have a clear picture about the depreciation accounting for any kind of firm. Easy comparability of the financial statements. For example, one company follows the LIFO method of the stock taking accounting. Other company can also follow the FIFO method. FIFO indicates first in, first out, or it may be a weighted average method. So, if the memorandum of association of the companies, it gives the clear picture like which type of stock valuation methodology is followed by the company, it will be easy for an auditor and also for accountants to make the accounts more proper in a proper way and to make the comparisons. Assist the auditors. Again, as I told you, like accounting standards helps the auditors to give the detailing about each and every item. Makes the accounting informative, easy and simple, and it also avoids the frauds and manipulations and gives the reliability for the financial statements. Now, these are the various accounting standards given by the accounting standards which are accepted, generally accepted accounting principles, such as AS1 indicates the disclosure of accounting policies. Like a company, how the company is supposed to disclose the accounting policies for its internal as well as external sources. Like in the prospectus of the company, companies are required to make the proper detailing of what the kind of proper accounting policies they are supposed to follow. AS2 revised, it indicates valuation of inventories, that is stock valuation, how these stocks will be valued, what kind of books and registers are required to be maintained, also which methodology is required to be followed. AS3 gives the cash flow statements. Cash flow statement includes the cash flow from operating activities, from investing activities, and also from financing activities, which indicates what type of how the company's cash is calculated. Like, for example, what was the opening balance of cash in the financial on the first day of April of any financial year, and what is the closing at the last day of the 31st of March for the accounting year. So whether the cash tallies or not, and in which particular item major cash flow is involved. AS4 indicates contingencies and events after balance sheet dates. There are various events once the balance sheet is framed. There are certain events which happens after balance sheet date. How those events will be recorded, it is given in AS4. AS5 indicates net profit or loss for the prior period items and changes in the accounting policies. AS6 gives the detailing of depreciation accounting, which methodology to be followed, like WDV method, that is written down value method, straight line method, which means the original cost method, and other methods also. AS7 gives the accounting for constructions contract. AS8 gives the accounting for research and development. AS9 gives the revenue recognition and capital expenditures detailing. AS10 is related to the fixed assets accounting. 11 gives the information about the effects of changes in the foreign exchange rates. Now, foreign exchange accounting, if the companies are working and trading globally, so here it is very important for a company to make their accounting on the basis of the current rupee as well as Indian currency, that is rupees, and also the company trading globally, like for example if it is US, so US dollars. So the rates of foreign exchange get changed, so it is very important for a company to make a recording of it. AS 12 gives the accounting for government grants, AS 13 gives the accounting for investments, and 14 reels related to the amalgamations, mergers and takeovers. If two companies merge together, how the accounting will be done after merger effects. And AS 15 is related to the employees' benefits such as bonus shares, employee stock exchange plans, right shares, or any other benefits given to the company's employees for their benefits. So these are the various accounting standards, and in detailing there are the other accounting standards also, like AS 16 it will relate to the borrowing cost, 17 related to the segment reporting, 18 related to the related party transactions or disclosures, such as we have different parties like creditors, bankers, institutions and all. 19 is related to the lease financing, 20 is related to the earning per share, 21 it's related to the consolidated financial statements. If a company is having the various branches and one head office, so there a company is supposed to make the consolidated financial records at the end of the year. 22 is related to the accounting for taxes. 23 is related to accounting for investments in associated consolidated financial statements. 24 is disclosure accounting and discounting accounting operations, and 25 is related to the interim financial reporting. 26 is related to the intangible assets, like we have various intangible assets, goodwill, patents, copyrights, trademarks, how these assets will be valued and what are the norms to be for the valuation, what are the methods, that is given in AS 26. And AS 27 is related to the financial reporting of interest or in the joint ventures. So these are the 27 different accounting standards. There are the advantages as well as disadvantages for the same. It gives the maintenance of the financial records. It establishes the financial statements. It is it helps in the decision building, and it helps for the legal concerns as an evidence in the court of law. It presents the information to the relevant parties also. Now, there are certain disadvantages also. The accounting report is based on the estimates. Again, all the accounting standards are based on the estimations, that is assumptions. So, if there are the chances of possibilities of the occurrence of the errors. Registration of fixed assets at the original cost. In accounting standards, there is a norm that all the fixed assets will be registered on the original cost. However, the fixed costs are getting depreciated day by day. Manipulation of statements of accounts express the information related to the accounts in terms of money. Everything is expressed in terms of money. However, there are the certain expenses which are non-cash expenses, and also certain things which are invisible like goodwill, intangible. So they are also expressed in terms of money. So this is all about accounting standards. I hope this video finds you well. Thank you.